Good afternoon. Gong Hei Fat Choi. Welcome so much to the first Investment Insight series of 2024 for St. James's Place, Asia and Middle East. My name is Angelina Lai, Chief Investment Officer for St. James's Place, Asia and Middle East. I'm delighted to be your host today. In today's special edition, I'm really pleased to be welcoming our new Group Chief Investment Officer, Justin Onuekwusi. Justin has held many prominent roles during the last 20 years with the likes of L&G, Aviva, Merrill Lynch and Aon, and today offers you the opportunity to hear from him on a variety of subjects, including the development of our investment proposition, asset allocation approach, and the selection of our fund managers. Now, I'm aware that we have a large number of you joining us today from across Asia, Middle East, and other locations from around the world. So thank you so much for joining us wherever you are. Just a couple of brief housekeeping. Do ask questions as we progress through today's conversation using the Q&A function that hopefully you can find on the control panel at the bottom of your screen. We do have a lot of us on the call today, so we will be doing our best to answer as many of your questions as possible. But if we're not able to cover your questions today, we will ensure that we will follow up with you after your call. So with that, let's dive right in. Good afternoon, good morning, Justin.
Morning, how are you?
I'm good, thank you, and thank you so much for joining us today from the early mornings of the UK. I've had the privilege of obviously having some rather in-depth conversations around asset allocation views, technical fundamentals, market, and all things technical investment with you. But just to give our audience the opportunity also to get to know you a little bit more, can I perhaps ask you to start by briefly introducing yourself?
Course, and the privilege has been mine, and to be honest, I've really enjoyed the conversations that we've had so far. So yeah, I'm the new Group Chief Investment Officer. I joined in October of last year, and before that, as you mentioned, I was at Legal and General Investment Management. I was there for about a decade. I managed multi-asset funds, so I was head of retail multi-asset funds there. So all of the multi-asset funds that were going into the retail business, so that's wealth management and financial advisory. Towards the end, I oversaw the entire investment floor for that retail business. So effectively like the CIO of retail. Citywide AA rated, so performance over the decade was pretty strong. I think you can still look it up on Google. I've still got the Citywide AA next to my name. And so I was at a £1 trillion asset manager, right? So the largest UK asset manager, and now moved to be CIO of St. James's Place. And maybe a question that you're asking is why make that move? Why make the move from dedicated investment management over to wealth management? But I do see that we are a world leader in wealth management. Okay, predominantly focused around the UK. I see huge amounts of growth area in Asia and the Middle East, which is why I'm so delighted to be here today. But there's just two things that I wanted to mention. Last things is that I think it's really important we think about the investment proposition, and it's not just just about the IMA. It's about the entire global investment proposition. To think about asset allocation. So let's think about how we get better, how we create a stronger platform for asset allocation. So build on the market leading asset allocation that I think we already have. Choice. So let's think about, okay, outside of that concentrated active, almost bread and butter, what else can we do? What else can we do to help partners connect with their clients? And finally, communication. I think communicating with partners, communicating with the outside world is really important. And then when we think about the asset allocation, we're making a number of hires to really bolster the asset allocation, which I think will really help, as I say, not just the IMA proposition, but globally, where I think we can really kind of benefit from economies of scale.
That sounds really exciting. I'm sure a lot of our clients and advisors will be really, really excited to hear about that. And obviously, a very, very impressive record. So I'm certainly very much looking forward to the next step of St. James's Place proposition. But let's look back to I guess market views, what we're here to talk about today. And a lot of our clients probably at the edge of their seats waiting to hear sort of your views. So last month, St. James's Place published the annual outlook. And so can you please take us through sort of our current house views from a market perspective?
Yeah, of course. So I think we can pull up the slide actually, but I think before we start, it's really important to underpin any house view with what you truly believe. So since October, I've tried to build a real foundation for thinking about how we want to take risk and how we want to have house views. And really there's 4 parts of that foundation: a client focus, active management, and this isn't just active stock picking, it's also thinking about asset allocation, diversification, which I'm sure we're going to come on to a little bit later on, and finally discipline. Can you avoid the poor behaviors that can lead to detracting from client outcomes? Absolutely. So that's the foundation, the foundational 4. Sorry, you're going to say.
Yeah, I was going to just say that's really, really important. I think a lot of times I quite often have sort of conversation with clients, quite often that comes to fund or stock picking, but actually genuinely I think there's a lot of value add from both asset allocation perspective, which I know that you'll talk through now, as well as also the value of behavioral investing, which obviously we quite as SJP believe quite strongly, and that really is part of the value add of through the advice. But again, back to you on the market views.
Yeah, no, I completely agree with you. So I think the first thing with a house view is to realize a house view is not an economic view. A house view is ultimately where you're taking risk. So one of the things that speaking to the team is that we've asked for a focus on risk and not positioning. So the two can be very different. You can be positioned a certain way, but the risk you're taking can look very different. So in terms of equity risk, you'll see at the moment we're neutral. What does that mean? It means that when equity markets in general go up and down, we are pretty much from a neutral rate relative to risk. But actually, you'll see from the portfolio positioning point of view, we're actually underweight equities. So what does that mean? It means that within the equity market, we're taking higher risk. So how are we doing that? Well, first of all, you can see the 2 pluses there, or 2 pluses: credit risk and emerging market risk. So firstly, by taking a higher amount of credit risk, this having a higher weight to high yield, it means that ultimately that's affecting the overall beta of the overall portfolio. So we've got a sizable overweight to high yield. We are currently debating whether to take that down. It had a very, very good run in 2023. Outperforming UK, emerging, I think European markets as well. So really, really positive performance from high yield. So we're looking at how we kind of trim that risk overall. And then within equities also, we're taking a higher weight to emerging market risk, so emerging market equities. Why? Mainly driven by valuations, but we'll come on to a little bit more on emerging markets a little bit later on. But ultimately, valuations underpin everything we do within these asset allocation views. So neutral on equity risk, positive on credit risk, really positive on emerging market equity risk, neutral on duration. So more recently, in the last time we sent out some asset allocation views, we reduced our high yield exposure a little bit, as I said, and started to increase our government bond risk overall. We've got sterling risk there, but effectively that is just the kind of currency risk we're running in portfolios. I'd say we're relatively neutral. It's just slightly positive. I wouldn't take too much into that. The last one I think is going to become more important over the medium term is the inflation hedging capability that you have within the portfolio. There is a real risk at the moment that even though inflation overall is coming down, that actually it's going to remain stubbornly above target. So therefore, one of the things I've tasked the team to do is start to think about that inflation risk and how to mitigate any stubbornly high inflation levels going forward. So overall, that's the overall view: neutral equity risk, neutral duration, positive credit risk, positive emerging market risk. At the moment, neutral inflation risk, but ultimately you'll see the position at the bottom. We are underweight equities, but taking more risk within the equity market, and we have about a neutral allocation to sovereign bonds overall. I'll stop there.
That's quite interesting, right? And I mean, we're pretty much, I think, for the last year or so, cannot talk about markets or outlook without talking about the Magnificent Seven, which is essentially, well, it's actually just 7 stocks within within the US developed market. But it's quite interesting because, particularly for those that are based in Asia, probably sort of a closer to how the stock markets are doing here, which isn't very well. So it's very, very interesting that we have a double plus next to the emerging market risk. And I guess this is probably something that we are linking back to the diversification dilemma that as and James face, we have been talking quite a bit about in the last few months. So could you maybe elaborate a little bit on that?
Yeah, so as I say, you know, when we think about our asset allocation views, valuations are the anchor. That's the fundamental way we think about taking risk. However, valuations can sometimes take a long time to come to fruition. And therefore, we look at 3 additional aspects to help us assess whether it's the right time to get into any asset class. Those 3 things are the economic cycle, fundamentals, and tail risks. So let's just look at the economic cycle just for a second on the next slide. I do think this is important because essentially, when I joined, I hired an economist, so Hetal Mehta, to help really kind of get to really understand what's driving the overall economy at any point in time, because it's, as I say, it's one of the key moderators to the asset allocation view. Really importantly, she has a base case. However, and this is again really important, it's not important what the base case actually is. What's really important is how much conviction and how much probability you give to that base case. And what you can see right now is Hetal currently believes that we're in this kind of muddling through stage. That's her base case. Yet there's only a 30% probability of that. So it means there's a 70% chance that that base case doesn't actually come to fruition. So that means there's lots of uncertainty, right? Lots of uncertainty about the overall economy. So the natural reaction then is to go, right, if there's lots of uncertainty, let me spread my risk over lots and lots of different asset classes. Let me diversify. But the big challenge, Angelina, as you know, is that diversification simply has not worked over the last few years. We can point to the role of bonds in portfolio. So over the last 3 years, when investors have really needed their bonds to provide protection relative to equities, actually that really hasn't happened. Secondly, as you mentioned, we've had such narrow leadership in equity markets. So you've seen a handful of stocks dominate the market. And it's not just, usually when you see this concentration risk in history, it's usually driven by an individual market. But the other issue is that the US has continued to outperform the rest of the world. So it's not only the concentration within the US, it's that the US has become a bigger and bigger allocation relative to global markets. So it hasn't made sense to even spread your risk outside of the US into Europe, into Asia, into China, into emerging markets, into the UK. It simply has not made sense over the last few years, or it hasn't worked, I should say. But really importantly, we are coming to a turning point where it's no longer about performance. It's about the risk you are taking to generate that performance. So I do think with this uncertainty, with this huge concentration risk, it's so important to think about spreading risk over lots of different asset classes in order to provide a smoother return stream over time. And history tells us that concentration doesn't last. And history tells us that diversification is the best way to deliver the best risk-adjusted outcomes.
Absolutely agree. I mean, we quite often talk about diversification being the only free lunch investment, but actually, what was quite interesting is sort of your earlier point really around it's not just spreading across every risk spectrum, right? It's about looking at sort of what's the best risk to be investing in, and being aware actually to start with what your investment profile looks like, your investment portfolio look like, and then sort of choosing the risks for the time horizon. Well, that's sorry, go on.
I was going to say that there's one last thing I wanted to mention actually, is that valuations are the anchor, moderated by economics, but also moderated by fundamentals and tail risks. And on the tail risk, I do think this is really important to mention, because we have a huge amount of election risk coming this year, which is likely to mean that individual markets, in particular bond markets, become more volatile. Clearly, we've got geopolitical risk worldwide, which is, again, is something to really take into consideration. And last but not least, we've had the highest increase in interest rates for about 30 years. So significant tail risks in 2024. The one risk I wanted to talk about, which is starting to get the headlines, is on the next slide. I do think this one is a really important risk. So given we've got this US election and policies are starting to come out and be formed, it looks like Trump is going to get the Republican nomination subject to legal challenge. It looks like Biden is clearly going to be up against him. And typically, as you come into election year, markets don't tend to get volatile or react until about 2 months, 6 weeks before the actual election, when policies really start to become more concrete. One of the things that is clear is that both candidates are going to want to do some sort of fiscal giveaway. However, one big challenge is this: the US deficit at the moment, the blue line, is around about 7% of total US income. So the US is borrowing currently 7% of their total income that they're making every single year. So that wouldn't normally be such a problem. But the unemployment rate, the orange line, is really, really low. And it's one of these economic graphs, by the way, where you've got budget deficit on the right-hand side, and you've got the unemployment rate, on the left-hand side. So unemployment currently around about that 3% level. So it's at pretty much an all-time low. Why is this a challenge? Actually, unemployment being low is good, right? Everyone's employed, everyone's working. Well, we know this uncertainty around the economy could mean that unemployment starts to rise. If unemployment starts to rise, it means then more people will claim unemployment benefit, and that budget deficit is likely to increase significantly. So there isn't much maneuverability, if that is a word, for those presidential candidates to really, really focus on fiscal giveaways, given this dynamic, the high deficit, really low in unemployment. So this is a tail risk that we're looking at in 2024. And it could mean that treasuries, so US bonds, actually become a little bit more volatile. So it's just something that we're looking at. It's not necessarily going to happen, but a tail risk are things that we think could happen that could have an impact on portfolios overall.
And I guess sort of so that's quite interesting from an interest rate perspective. And I know you mentioned and talked about the credit risk as well, because obviously credit in both corporate and high yield has done pretty well last year, and we currently continue to cautiously favor, shall I use those words, in our portfolio selection. But any sort of, would you like to expand a little bit, I guess, sort of before we move on to the potential impact from US elections, even sort of to the EM risks on the high yield and credit side?
Yeah. So we have benefited from having that higher position, as I mentioned. So high yield, even though it tends to be lower risk, lower volatility than equities, has outperformed a lot of equity markets in 2023. The big challenge with high yield is that the spread, the credit spread, so how much you're compensated for taking that credit risk, is now really, really low. It's really tight. So it means that you're no longer getting that really significant compensation that you were 18 months, 2 years ago. When you look at high yield overall, there is something that's quite attractive. You look at the overall yield and you think, oh, getting like 7, 8, even sometimes double digits in terms of yield. However, a lot of that is driven by the government bond yield being at the levels that it is. So we're currently having a debate actually around high yield and whether actually we want to take that down even further. Because remember, the last asset allocation change that we made was essentially taking high yield from a double plus to a single plus. I do think there are arguments on both sides really, but it feels that high yield now is starting to look expensive relative to equities. So if I think about the direction of travel on that credit, or particularly the high yield position, I think the likelihood is that we're going to be trimming that even more. However, the decision hasn't been completely made yet. I think it's really important to look at it relative to what we think the equity market is going to do. But overall, that uncertainty is concerning me because ultimately 70%, okay, the base case is muddling through, high yield might do okay in that scenario, but it's that negative scenario which I'm really concerned about. And if you're not being compensated by it from the credit risk, then actually it makes sense, I think, to start to think about how we start to bring that high yield position down.
Absolutely agree. And actually sort of, I guess the other side to it, which is sort of a lot of the potential inefficiencies or the disparities within sort of the yield curve space that we talk about is really sort of the amount of quantitative easing that sort of even from the COVID year 2-3 years ago. And I think that's still causing, I guess, the market to not be so efficient. And we're quite often within the fixed income space talk about the 2027 war, i.e. the companies that had managed to restructure sort of a lot of their debt in 2022 and therefore enabled, I guess, that tight credit spread. So certainly that's something that, as you say, within the SJP investment community, we are certainly watching and monitoring and talking about the positioning of. But sort of switching gears a little bit, and I sort of alluded to this earlier, and I think a lot of our audience will be quite interesting, is our EM view. Now, I've put up this graph, and I think many of our clients probably are quite familiar with it. I published it for my 2023 reflection in terms of how EM had performed in the first decade of the century versus the last decade of the century versus S&P 500, which is very much a game of two halves. And and it's quite interesting, sort of, you mentioned that we're probably potentially at another reflection point. So could you sort of expand a little bit on that, both in terms of the upside, but also the tail risks that you mentioned in relation potentially to US elections and other election risks that we might be seeing this year?
Yeah, let me start with the election risks. I think that it's actually very difficult to think about how you position your portfolio based on that election risk.
Yeah.
So a mantra that I have is you have to prepare and not predict. You cannot predict what's going to happen. And even if it does happen, it's unlikely to manifest itself in markets the way you think. There's all other different variables. But there is clearly an investment risk premium on I'd say on global markets rather than just US. Actually, you saw as you got closer to the election last time, every time Trump was doing well in the polls, actually you were seeing Chinese equities sell off. So I think it's important to the US election in particular becomes more of a global election given the size of the US economy relative to the rest of the world. I do think this chart is really fascinating because, well, first of all, it shows that two very different environments, which I think is really important. But also, from 2010 onwards, what's really interesting is that emerging markets, you'd think that, that's a long time horizon. You'd think that actually you get compensated for taking the extra risk. But that clearly hasn't happened over the last 14 years. However, valuations right now are at real extremes. This is the cheapest emerging markets has been relative to US equities for over 2 decades. So this is extreme cheapness in terms of valuation. But just to provide the other side of the argument, because I think it is important to be balanced, is that although valuations underpin our asset allocation, there are other elements that actually are of significance, probably more so in emerging markets than in developed markets. And one is around the macro and getting the macro right. That tends to have a bigger impact in emerging markets than in developed markets. So one of the things that we are looking to do a little bit more, obviously brought Heckle in, looking to bring in 2 strategists as well. So somebody to focus purely on this relative value between different equity markets, so an equity strategist, then a fixed income strategist to do exactly the same, thinking about the fixed income side. But ultimately, it's the valuations that underpin our double plus in emerging markets. We're still positive and will continue to be positive purely because of the extreme valuation case at the moment. There is clearly a big Chinese element there, which I think is really important to discuss. I think there is, a huge challenge with the housing market in particular and how China navigates that debt overhang. But maybe we'll talk a little bit more about that later on when the questions come in, because I've got a lot to say about that. But still positive on emerging markets, especially relative to the US.
Actually, let's actually go straight into the sort of the China question, because in a lot of our within the sort of registration where we're asked you to sort of be putting out the question, and I think quite a number of you have asked what are our views on the road to a China recovery? What are sort of the trigger events that could potentially be sort of looking at a China recovery, etc. I think everyone's pretty much seems to be in agreement that we will be certainly getting a China recovery. The question is what might trigger that, and I guess the golden question, when might that happen?
Yes, so I think clearly the real dilemma is around this kind of housing construction boom, and clearly there's probably too much construction and a debt overhang. And I think that very plainly that there are 2 choices. You bite the bullet now, you take all the pain, and then you just stimulate the economy like crazy after that. Or you let this drag on, you create these zombie companies, and ultimately you won't see massive downside, but ultimately you don't let the market correct. I think at the moment we're in that second camp. And ultimately, I think in order to really see long-term structural significant outperformance, in order to really reward private risk takers, so effectively the equity market, then you need to let companies that are not doing well go bust. And you need to have winners and losers. So I think that's a significant challenge. And it probably means that structural reform is needed for the really, really long term. And clearly there's other headwinds like demographics, higher savings rates, which are challenges. But actually over the medium term, you've got that huge valuation case in favor of the Chinese market. It's clear that over time you're going to see different types of stimulus in order to boost that market overall. So I think right now it kind of makes a lot of sense to be taking risk. However, in order really to, I think for the Chinese equity market to fulfill its potential, then you need to get rid of that moral hazard. You need to make sure that companies can go bust, and you need to reward private risk taken. And I think from an international investor, that's the big worry, is that from a really longer term perspective, you're not going to get rewarded for the risk that you take.
Very interesting. So I'm starting to get some questions coming in, and please do make sure that you are typing in your questions in the Q&A section. I've got a question asking, what's your outlook on the Indian market? Now, of course, last year has been quite a strong market for India, but then from a valuation perspective, particularly sort of relative that to China, it's not quite the level of US versus EM. But where are we from an India perspective going forward as an investment?
Yeah. So I want to caveat this by saying that I'm not an Indian expert or an Indian equity expert, but I do have some views on it, and my views are kind of long term, or sorry, medium term, rather than very short term. Firstly, well, let's do this. The first one is short term. Thinking about the election risk premium this year, I think you have to add some extra volatility to Indian equities, given that we're in this election year. Relative to other emerging markets, however, Indian equities have always looked expensive, and partly this is because relative to other emerging markets, India tends to have more private involvement. So there is less of I suppose, a government discount on Indian equities. And you tend to get, coming back to my China point, you do tend to get rewarded. Private investors do tend to get rewarded, and companies do tend to fail, which again is really important for a stock market dynamic. The growth in India is clearly pretty attractive from a medium-term perspective. And I don't think, even though relative to other emerging markets, it looks pretty expensive, I don't think you're still pricing in the full growth potential of the Indian market. So I think from a medium-term perspective, you have to be pretty positive. It's clear that India is going to become a larger and larger economy relative to other economies in the world. The largest democracy and so on and so forth. So actually, I do think that it's hard from a medium-term perspective not to be positive. Whether now is the right entry point is another thing, given the strong performance last year and given the election this year. But it does feel that actually, relative, if you're going to take a medium-term position, that India is actually a good place to do so.
Absolutely, and it's quite interesting because in talking to some of our fund managers, particularly the EM fund managers, certainly my feeling from sort of the discussions is that last year there's a lot of they're sort of citing a lot of very interesting opportunities, and probably at the beginning of the year before sort of some of these growths in 2022, actually, while it was a bad year, it was actually a pretty good year from a fund manager perspective, because there's all sorts of opportunities, good opportunities at rather cheap rates. So certainly last year there was a lot of our EM and Asia Pacific fund managers talking about the sort of significant levels of interesting opportunities in India. Whereas this year, I've certainly noticed with a lot of our EM fund managers saying, well, actually, we're finding a lot more attractive opportunities, and for opportunity cost reasons, they're actually diverting their funds away from India. So effectively taking some of the profit and investing into more interesting quality Chinese opportunities. So that's certainly a very interesting bottom-up observation rather than sort of from a top-down asset allocation perspective. That's really interesting. And again, sort of, please do continue to be asking questions through the Q&A box. Now, while we sort of wait for some further questions to come through, oh, actually, so we just had another one that I was going to start talking about, the sustainability one, which is obviously one that I'm very, very passionate about. But okay, so I've got a question saying that SJP talks a lot about fund manager selection. Obviously, I just talked about that. So will this continue to be important under your reign?
Yeah. So look, fund manager selection has been really important. I actually think it's important to actually tell a little bit of a story here. Is that when SJP was formed, and maybe this is kind of repeating some of the ACM actually, but when SJP was formed, there was a focus on these staff fund managers, and as we got bigger and bigger and bigger, individual staff fund managers didn't really make sense anymore, and it became all about blending those managers in the right way to try and continue to deliver strong performance. I think now we're at a stage where asset allocation and getting the asset allocation right is really fundamentally a key focus. However, it's really important that select manager change, picking the best fund managers, is really ingrained into what we do and how we pick building blocks. The one thing that is really important is that the market has evolved over time, right? So over time, you simply just have more investment options. So you don't just have this concentrated active, you also have this kind of continuum right through to market cap index. And on that continuum, you've got things like thematics, you've got things like sector funds, you've got things like systematic equities, you've got things, you've got so many different overall strategies on the active passive continuum. And actually manager selection right across that continuum continues to be important. So we shouldn't fool ourselves that because we're not purely going to be concentrated active, we're going to offer different elements along that spectrum, that fund manager selection isn't still of utmost importance. So very long answer to your question. Yes, fund management selection is going to continue to be important, and and is fundamental to our success.
Absolutely, and I'm glad to hear. And one of the other questions, which I guess is related, is our views on active versus passive. And I guess this is where you're talking about choice, right?
Yeah. So I think the market has backed themselves a little bit into a corner, and there's almost a belief that it's about active or passive. And actually, as I say, I don't think it is. I think there is this continuum. And different investors will want to take different levels of active risk. And I think it's really important that, 20 years ago, there wasn't this much choice. There wasn't this much of an investment universe. Like, I go into Bloomberg now, and there are hundreds of thousands of different ways of accessing the same market. So I think it's really important to really just understand the market, understand the options, and then really select the best ones that we think in each space. What I do think we do have to do is we do have to offer more lower cost options. And this is some of the conversations we've had, Angelina, is how do we do that in an effective way and still deliver strong client we can deliver.
Absolutely agree. And I guess also the other part, and some of which we were hinting at earlier through sort of the bottom-up opportunities as well, is that active allows us to be selective against the risk, I guess, we take, whereas it gives us potentially a lower choice, lower cost option, but you are sort of slightly less able to choose or select the risk that you're participating, which actually quite interestingly links into the next audience question. Namely, do you see some more upside in the Magnificent Seven stocks? And which stream market do you recommend in 2024? The eternal crystal ball questions.
So on that second question, I'm probably not going to answer that, because I think it's so hard to make yearly predictions. And if I do make a prediction on what's going to happen in the next year, you're more likely to be wrong than right. And this is always the case, and there's been like lots and lots of studies done into this. So I'm going to park that one if that's okay. And I'm not just sitting on the fence. Actually, I don't believe in making 1 year predictions. But anyway, Magnificent Seven though. Look, these stocks have continued to outperform the rest of the world. At some point, you get to a point where the elastic band has to snap. You can't, what they kind of 30% of the S&P 500 at the moment. So 500 stock index, 7 stocks making up 30% of the overall index. That is pretty unsustainable, and it can't continue in the future. The other thing that can't continue in the future, and I think this one's actually more important, is the US relative to the rest of the world. The US has gone from 40% of global market cap to 60. I think it's actually called 70 now % of global market cap. That means the US is double all of the regions combined. And you've got some, really scary some scary elements of the stock market now. That Nvidia is bigger. I think Nvidia is bigger than the UK market cap, and so on and so forth. You've got these, really, really strange dynamics in markets, and at some point that bubble is likely to burst. And rather than see it through a performance lens, and I know it's really difficult because that's the way clients will see it. It's important to see it through a risk lens and say, how much risk are you taking to generate that performance? And unfortunately, chasing those Magnificent Seven up and up and up, you're taking more and more and more risk. It's really difficult to argue that 15 years ago, that US equity, so the S&P 500, is not more risky today than it was 15 years ago. Really hard to argue with that stock concentration. So ultimately, if you're taking a portfolio view and you're taking the same amount of risk, you ultimately want to allocate less to it. And I think that's the way to look at it, through a risk lens rather than a performance lens. And unfortunately, it could carry on going. But ultimately, as it carries on going, you're taking more and more and more risk. And I think that's the fundamental thing.
Talking of risk, we do have a couple of questions coming in on a asset class that we don't tend to talk a lot about, but had been making some big headlines in 2020 and 2021. You probably can guess what's coming up. So do you have any views on crypto, particularly with the increase in Bitcoin prices, I guess, partially stimulated by all the ETFs with some of the bigger houses?
Yeah, so I mean, it's really hard to have a fundamental view on cryptocurrencies overall. Well, first of all, they're not a store of value or a medium of exchange, really. So, and they're the fundamental rules of any currency. So, not really a store of value or a medium of exchange. So you kind of go, well, they're not really currencies. But then they are, I would argue, they are doing something that's obviously generating returns, and ultimately it's somebody's willing to buy them at a higher price than you. So there's like a demand and supply. It's really difficult to assess the demand and supply of these cryptocurrencies. The one thing that I would say is that digital currencies overall, it's hard to argue that they're not the future. The difficulty is then, how do you back? Yeah, which one's going to be the winner? And what you do know, again, if you pick one currency and you're like, this one's going to be the winner, ultimately, you know that the likelihood of that one being the winner in 5-10 years time is effectively close to zero, because there's so many cryptocurrencies out there. I do think it could make sense, not now, but it could make sense in the future, of having a diversified crypto basket of lots and lots together, because that ultimately what you're saying is that some of these are going to be the winners in the future. What I really struggle with is, without real regulation of the entire market, I really struggle with whether actually a lot of these currencies, as we know, are really going to exist in the future, because ultimately the market needs to be regulated. And there have been loads and loads of scare stories about people losing everything and not being able to find their wallets and so on and so forth. You know, we really need to have some sort of regulation, not only on the individual currencies, but on the exchanges that these currencies are traded on.
Absolutely. Okay. That's been really, really interesting. And thank you so much for your time today. And I mean, I always enjoy our conversations. I do hope our audience has also enjoyed our conversations. So thank you very much for everyone to be dialing in. Oops, sorry, I missed the question slide. But I will park on the acknowledgement, this slide. But thank you very much for everyone for dialing into that completes today's conversation, and thank you so much for your time and for your engaged listening and your questions. We do hope that you found this discussion as enjoyable as I and hopefully Justin have done. And thank you, Justin, very much also for your time and your insights. Now, if we didn't get to your questions, or if you have any further follow-up questions, please do get in touch with us or with your St. James's Place partner or advisor. And if you are interested in any further events that we might be running, you can find out more by following our various social channels. And of course, you have those QR code on the screen that will help you to get to these. So in the meantime, thank you so much. Do keep well, and I look forward to seeing you at our next event. Thank you.
Thank you.